In these sessions, we will be addressing the Tax Simplification Package, which was adopted by the European Commission on 24th June this year. For a number of years, the Commission has been working to make EU legislation simpler and less burdensome as part of a broader effort to make the single market work better and more efficiently for businesses. Direct taxation is one area where complexity remains particularly significant. Over the years, the EU has built an extensive framework of directives to facilitate cross-border business activity. While these rules have supported the functioning of the single market, they have also resulted in increasing complex legislative landscape. Against that background, the Commission has proposed a comprehensive review with three main objectives: to simplify the rules, to reduce unnecessary administrative burden, and to remove tax obstacles that continue to hinder cross-border investment within the EU. So what does the package actually consist of? The package contains two legislative proposals. The first is the direct taxation omnibus proposal, which simplifies 6 existing directives in the area of direct taxation, including the parent subsidiary directive, the interest and royalties directive, and the merger directive. Among the key measures here are the abolition of withholding taxes on cross-border payments of dividends, interest, and royalties for companies in the EU, what effectively removes costly and time-consuming refund procedures. Also, the extension of parent subsidiary directive to certain pension institutions, and the introduction of modernized interest limitation rules under ATAT. The second proposal is the recast of the Directive on Administrative Cooperation, or DAC recast. It consolidates the 9 existing directives into a single legal instrument with the primary objective of reducing reporting obligations. In practice, this brings several concrete simplifications, including an exemption from DAC 6 reporting for groups already within the scope of Pillar 2, and a substantially higher reporting threshold for online sales, what essentially removes millions of private sellers from the reporting obligation. So what are the next steps? Well, both proposals now go to the European Parliament for consultation and the EU Council for adoption. This process is expected to take time. If adopted as proposed, the direct taxation omnibus would apply from 1st January 2029, while the DAC recast would generally apply from 1st January 2028, with certain provisions taking effect in 2030. With that overview in place, let's take a closer look at some of the key proposals within the package.
I will start with the taxation omnibus and focus first on one of the measures that plays a central role in the package, the change to the material scope of the interest and royalties directive and the parent subsidiary directive. As a reminder, the directives exempt interest, royalties, and dividend payments between associated companies in the European Union from withholding taxes and eliminate double taxation, subject to a minimum holding of at least 25% for the interest and royalties directive and 10% for the parent subsidiary directive. The taxation omnibus proposal is to remove these minimum holding requirements. So, if adopted, dividends, interest and royalty payments between in-scope companies within the European Union would benefit from the directives irrespective of the level of participation held between them. The Commission estimates substantial simplification benefits for businesses from this measure, around 5.3 billion euro per year out of 8 billion euro from the whole simplification package, so the omnibus and the recast. At the same time, this is likely to be one of the more politically sensitive elements of the package. While, as we heard from Ola, most of the proposed amendments in the omnibus would apply from 2029, the removal of the holding requirements is scheduled to apply from 2037. So this extended transition period reflects potential short-term budgetary impacts for member states and the need to provide them with extra time to adjust. Moving forward, Laura, when taxpayers qualify for these benefits, will it actually become easier for them to access and apply the directives?
Well, that's an excellent question, Oana. The taxation omnibus actually addresses this issue. It proposes that the member states could not require prior authorization or impose special administrative procedure on the taxpayer before being entitled to the benefits of the parent subsidiary directive and the interest and royalty directive. The evaluation would be based on a self-assessment. On the other hand, there is the need to prevent double non-taxation. Hence, the amendment to the interest and royalty directive entails that the source state could deny the withholding tax exemption or deny the deductibility of the interest or royalty payment if the resident state either has no corporate income tax or applies a zero rate on such income. Well, also the general anti-avoidance rule in the ATAD directive is updated to cover also the withholding taxes and top-up taxes. Well, another significant amendment in the scope of the parent subsidiary directive is to extend the directive to cover also pension funds, irrespectively of their legal form. This also in practice means the derogation from the subject to tax requirement. Last amendment worth mentioning is that also the annexes included in the directives will be updated. This applies also in respect of the annex attached to the merger directive.
Well, Laura, let's now turn to the proposed update to another of the EU older corporate taxation directives, the Tax Merger Directive. Just a reminder, the aim of the Merger Directive is to ensure tax neutrality for cross-border corporate reorganizations. However, more recent forms of reorganizations, as found in the Company Law Merger Directive, are not covered by the current scope of the Tax Merger Directive. Therefore, the Omnibus proposes to include within the scope of the Tax Merger Directive the following three transactions: a simplified merger, division by separation, and cross-border conversion. And this brings us to the end of our overview of some of the key changes proposed to the older EU corporate tax directives. Let's now turn to another important part of the Omnibus, the changes to ATAD.
Thank you, Oana. Well, regarding the ATAD, I would start by updating our ETF audience on the R&D allowance. This measure is introduced in a new chapter of the ATAD, and while the ATAD was adopted in 2016 as a minimum standard anti-tax avoidance directive, the Omnibus on taxation proposes amending it to introduce a minimum standard expenditure-based corporate income tax incentive in the form of an R&D allowance. If adopted, it would become the first binding EU measure of this kind. The R&D allowance aimed at strengthening the competitiveness and supporting innovation in the European Union would allow taxpayers to deduct from their taxable base capital expenditure on plants, machinery, and other tangible assets that are used to carry out research and development activities. The allowance can be claimed in full in the tax year in which the R&D expenditure was incurred or in any of the 4 subsequent years. In order to benefit from this regime, the qualifying expenditure must be used wholly and exclusively for research and development for a continuous period of at least 3 years. If that is not the case, safeguards will be triggered, possibly resulting in the clawback of the allowance. The proposal also clarifies that member states may always decide to provide for alternative measures to this proposed allowance in their domestic tax systems, provided that the qualifying expenditure is treated more favorably. Now, I will give the floor to Francesco to tell us a bit more about selected amendments to the anti-tax avoidance framework.
Sure, Carla. Let's turn to the proposed changes to the CFC rules. First, the Omnibus proposal seeks to harmonize the CFC framework across the EU by eliminating the current coexistence of 2 approaches for attributing CFC income to the parent entity, commonly referred to as Model A, or entity approach, and Model B, or transactional approach. Under Model A, the CFC rules target specific categories of passive income, whereas Model B focuses on non-genuine arrangements designed to shift profits to the CFC. This flexibility has resulted in divergent national implementations, increased compliance costs, and reduced legal certainty. The Commission considers Model A to be both more effective and easier to administer. By contrast, Model B often overlaps with transfer pricing rules and has provided limited additional value in practice. The proposal, therefore, abolishes Model B and establishes Model A as the single approach across the Union. Second, the proposal introduces further simplification through a number of exclusions from the CFC regime. In particular, the currently optional exclusion of situations involving limited amounts of passive income would become mandatory, reflecting the view that CFC rules should focus only on cases presenting a more meaningful risk of profit shifting. Most notably, small and medium enterprises would be excluded from the regime altogether. Given that only a small proportion of SMEs operate across borders, and even fewer have subsidiaries outside the EU, this exemption is not expected to weaken anti-avoidance effort, but instead it should substantially reduce compliance costs and administrative burdens for both businesses and tax authorities. And finally, the proposal addresses the interplay between the CFC rules and the global minimum tax regime. The Commission recognizes, in particular, the overlap between the CFC rules and the income inclusion rule. Running the two systems in parallel may lead to economic double taxation and duplicative compliance obligation. To avoid these outcomes, the proposal provides for a general exemption under which EU entities belonging to groups that fall within the scope of Pillar 2 would not be required to apply the CFC rules to their foreign subsidiaries. And it is worth noting that the same exclusion applies also in respect of DAC 6 reporting obligations. In addition, a targeted exemption is available where the ultimate parent entity is located in a qualified side-by-side jurisdiction, provided that the low-tax subsidiary is already subject to a qualified domestic minimum top-up tax and does not benefit from related refunds or financial incentives. And now I will give the floor to Angelika, who will cover the ATAD interest limitation rules.
Continuing with the proposed changes to ATAD, we now move from the CFC rules that Francesco walked us through to the interest limitation rules. The idea is to give the interest limitation rules a soft makeover. The Commission is trying to tackle fragmentation across member states, make the rules more business-friendly, and simplify their application in practice. The changes can broadly be grouped into two categories. A first set of changes wishes to reduce the number of implementation options that are currently available at the level of the member states. For example, the proposal would make the 30% EBITDA cap mandatory across the Union. This would mean that member states would no longer be able to apply a stricter threshold. This would require countries such as Finland, which currently applies a 25% threshold, and the Netherlands, which applies a 24.5% threshold, to align with the 30% standard. Similarly, the proposal would make the Euro 3 million de minimis threshold mandatory across the Union. This would practically mean that member states would have to allow taxpayers to deduct borrowing costs up to that amount. This is particularly relevant for countries such as the Netherlands, Romania, Portugal, and Spain, which currently operate with a Euro 1 million de minimis threshold. The second set of changes introduce carve-outs from the scope of interest limitation rules. The most important example of this is the new carve-out for low-risk third-party loans. Exceeding borrowing costs arising on third-party loans used to fund the taxpayer's own activities would be excluded from the scope of interest limitation rules, provided that those funds are not channeled elsewhere within the group. The proposal also introduces a safeguard clause for profitability shocks. Where a taxpayer's EBITDA drops by at least 50% compared to the previous period, then the interest limitation rules would not apply for that period. This is meant to prevent taxpayers from being further penalized in case their profitability drops significantly. Last but not least, and in a way serving to seal all these changes, the proposal also introduces a new paragraph 9. This provision would prevent member states from maintaining or introducing rules within their domestic law, which fall within the scope of interest limitation rules but depart from what the directive provides. In other words, after reducing the number of implementation options, the Commission is trying to prevent future divergence. And with that, we move from one makeover, the ATAD makeover, to another makeover, the DAC recast. Ruxandra, over to you.
Thank you, Angelika. While the DAC recast introduces important changes across the entire DAC framework, including DAC 1, 4, 5, 6, 7, and 9, alongside some broader horizontal provisions, I would like to highlight one key objective at its core: reducing low-value reporting under DAC 6 on mandatory disclosure rules and DAC 7 on reporting requirements for digital platforms. Both are areas where existing obligations continue to impose significant costs on businesses. On DAC 6, in addition to the carve-out for MNEs in scope of the Pillar 2 directive, as Francesco just mentioned earlier, another important change is the removal of Category A hallmarks. These are generic hallmarks linked to the main benefit test, covering arrangements such as confidentiality clauses, contingent fees, or standardized documentation and structures. Their removal is expected to significantly curb defensive reporting of otherwise routine commercial arrangements. In the same vein, the proposal clarifies the reporting trigger, aligning it with the moment when the first implementation step is actually taken. This tightens the current rules, under which the reporting trigger could also be when an arrangement is merely made available for implementation or when such arrangement is ready for implementation. One additional point on the main benefit test. While further guidance on its application was expected, this is not included in the current proposal. Instead, the European Commission indicates that further clarifications will be developed at a later stage. Turning to DAC 7, the recast introduces several measures to reduce low-value reporting. A new exemption is introduced for small and medium-sized platform operators where the annual consideration would fall below 50,000 euros. The reporting threshold is also increased from the current 2,000 euros to 3,000 euros, and the 30 transaction activity threshold for sellers of goods is removed. In practice, this is good news for occasional users of these platforms, making it easier to clear out closets and attics without worrying about triggering DAC 7 reporting obligations. Overall, these changes make compliance more proportionate to real risks and are expected to reduce the number of reported sellers by up to 11.3 million a year. More broadly, the DAC recast brings a welcome dose of pragmatism, reflecting a policy shift away from broader, burdensome reporting towards more targeted and risk-based disclosures that would better serve both the tax authorities and businesses. Notably, for DAC 6 and DAC 7, as Ola already mentioned at the beginning, the European Commission has set the most ambitious implementation timeline in the package, aiming for the start of the transposition already in 2028. But the DAC recast goes beyond these measures. Carla, perhaps I can turn to you for some additional highlights?
Sure, Ruxandra. I will briefly mention two DAC recast measures, starting with the update to the main provision of DAC 1. Currently, member states may choose 5 out of a list of 7 categories of income and capital to exchange information with other EU member states. The proposal deletes life insurance products from the list of categories of income and capital that member states could choose from. With these 6 remaining categories, they would all be mandatorily exchanged. I would like to highlight that regarding the real estate category, in addition to the ownership and income from immovable property, information on beneficial ownership would also need to be exchanged. The second measure I would mention is the introduction of a centralized verification system for the taxpayer identification number, the TIN. This tool, which would be mandatory for member states' tax administrations and optional for reporting entities, allows for a digital and automated verification of the correctness of the TIN. The use of this tool would allow immediate confirmation of whether a reported TIN corresponds to the reported taxpayer or whether no match could be established. According to the proposal, reporting entities using the verification tool would no longer need to collect and report additional identifying information. Instead, they would be exempt from collecting such information and would only need to collect taxpayers' name and TIN. This measure would reduce compliance burdens while maintaining data quality. And while the introduction of such a tool would require a one-off investment and entail yearly operational costs, it will also generate even greater savings due to reduced need to correct the reported elements. Ruxandra.
Thank you, Carla. We would like to thank you for watching our session covering selected issues on the simplification package. You can always find more information and resources on the IBFT Tax Research Platform and by subscribing to the EU Tax Focus newsletter.